I'm Jen, and thank you guys all again for being so patient with us, and welcome to another episode of Blockchain Banter. Oh, perfect. So Sophie's up here now. We're just waiting on Mark. Um, Thank you guys for joining us up here on stage, and thank you to all of the listeners for coming out this morning. I'm actually super excited to be speaking about oracles. It was actually what got me into crypto in the first place. So it's a nice conversation to be having, especially considering, how you can kind of approach oracles in DeFi. So thank you guys for being up here. Like I said, we'll start with a few introductions first. We'll introduce ourselves. Sophie, we have Dr. Sophie Liu from AgenFi. Maybe you wouldn't mind introducing yourself. Welcome back. Also, it's been a minute.
Okay, hi Jen. Hi everyone. Hope you can hear me now. Okay,
Perfectly.
great. Okay, hi everyone. I'm Sophie. I'm the data scientist from Meganfi. So we are a data platform that observes on-chain liquidity, especially all the MEV activities. And we also have been investigating on the activities that has been like backgrounds, oracles update to extract value that we call OEV, and also some attacks that originated from like the oracle manipulation. So indeed, notice that the Oracle has caused some threats to the DeFi ecosystem. So I'm very curious here to join the discussion to talk about the design of Oracle Lice protocols and how could that prevent this kind of the attacks happens in the ecosystem. So yeah.
Thank you so much for joining us. It's great to have you back. Steve, why don't you go ahead and introduce yourself if you would?
Yeah, hey everyone. Thanks for listening in. My name's Steve Everard. I'm a business development manager here at Pondal. What our current roadmap is looking like is we do a lot of peer-to-peer lending and borrowing, and we are currently building out a DeFi mortgage protocol, which will allow for long-term style purchases to be financed by individuals so that they can leverage traditional finance practices here on the blockchain.
Wonderful, and it's great to have you. Thank you so much. And Nicola, I know we had the issues. I'm glad we sorted them. Thank you for joining us. Tell us a little bit about yourself, if you would.
Of course, thanks again for having me. Hey everyone, I'm definikola. I'm coming from DeFi Saver. It's a one-stop management platform for your DeFi positions. Basically, we have automated leverage management and one-click loan shifts, for example. But yeah, I'm doing research there, basically trying to find new protocols that have potential to be integrated on the DeFi Saver, and on the other hand, try to avoid the unsustainable models. But yeah, I'm doing also the product development side on DeFi Saver, and I'm really excited to discuss the Oracle-free narrative in DeFi.
Well, it's kind of interesting. Well, I mean, we'll get into why I personally find this so interesting. Again, before we jump right into Oracle free DeFi, for anybody who might be new to DeFi, why don't we speak to what oracles are? What are oracles in terms of DeFi? Maybe one of our speakers wouldn't mind jumping in here and giving our listeners just a brief overview of what they are, what purpose they serve.
I can jump in and then let some others fill in gaps as well too if I'm missing anything.
Perfect.
At least just start at the 10,000 level view and then guess just kind of say that oracles allow for on-chain data to see into the real world, kind of like live time data, and kind of bridge the gap between those two. If anybody wants to get a little more specific, feel free to add on to that.
Yeah, one thing I want to add is Oracle is like a bridge, right? It's connect the on-chain and off-chain information. It's like access with blockchain. So you need the hard working to maintain like decentralization of oracles. And also, I was thinking like the data is collecting from the off-chain and pass it to the on-chain, but it's collecting the source from off-chain, which is totally like we don't know the source. It's kind of like unreliable. So some of the parties was using like a statistical method to filter on the information that they got from the off-chain source. But once there's like any manipulation, you could cause some threats or some troubles to the DeFi ecosystem. That's my understanding of oracles.
Exactly. And for example, I would like to add some specific use cases. Let's say we have a lending protocol that needs to know what is the price of the collateral it has onboarded, and that's the moment it just fetches the external price feed by calling the contract of some Oracle provider.
Thank you guys so much. So it really just enables, smart contracts, blockchain to access this external real world data. And the timing, I think, is kind of ironic here for our call, because I think it was the same day that I announced our call, there was news of another DeFi lending protocols Oracle being exploited. Did you guys happen to hear about that? About, I think it was EraLend on ZK Sync a few days ago. Maybe not familiar. It's kind of sad too, because I think it was maybe like 3.5 million, which I never thought I would say only 3.5 million, but I guess in terms of DeFi and exploits and things of that sort, it isn't so huge considering. But this was due to an Oracle issue. And I mean, I think Peck Shield had reported on it. Nicola, you're familiar, you heard about it a little bit.
Yeah, not really get into details what happened, but yeah, I saw that the Oracle was the problem. But yeah, and the protocol was on ZK Sync, as you said.
Yeah. So, I mean, I think that this is nothing really new. But I mean, and if you've been in DeFi for any considerable amount of time, I think you had to have heard about some sort of Oracle manipulation exploit. I think it was just this year alone, I was reading the other day, it was 106 flash loan and Oracle manipulation attacks, and they resulted in 245 million in losses so far this year alone. So the first half of the year, it was like one every other day and a half, something along those lines. And I have seen, and I think this is from me on the outside, I see so much talk of we need more secure oracles, but it really wasn't until maybe 2, 3 months ago, kind of when Carbon first launched. And I wish Mark was here, he could talk about it a little bit more, but there is no Oracle. And it was the first time that I had really started exploring Oracle less. And then there was this great big thread about how DeFi is broken. I'm actually going to pin it to the top. If you haven't read this research, you hadn't seen this thread, I definitely recommend giving it a read. But it basically said DeFi is broken. Last year, we had 3.8 billion stolen through exploits, Oracle exploits. And we need to fundamentally rethink how DeFi protocols are designed and secured. And the very first tweet in this 28 tweet thread was Oracle free protocols. Here's how to fix it. Number one, Oracle free protocols. And it wasn't too long after DeFi Nicola that you had posted about them. Maybe you can start us off and speak to them a little bit more for us.
Yeah, of course. Thanks. Well, I basically just laid out the protocols I've researched so far that basically do not utilize any external oracles, and that have find a way to trigger liquidations. Those being primarily lending protocols, and that they find a way to trigger liquidations without the dependency on the external price feeds. So yeah, I think that is a huge step forward in DeFi, because the Oracle risks, as you mentioned, Jen, is now being shifted from the core protocols to the end users. So yeah, I think I just laid out those protocols. I'm not really neither pro or anti Oracle, because I believe that there are both pros and cons for both of those. But yeah.
Steve, you want to jump in? Go ahead.
Yeah, I was just gonna say along the lines of the Oracle list protocol. Obviously, here at or maybe not obviously, but here at Pond, that's one of the things that we like to mention that is part of our protocol landscape is that we don't use oracles. And going into the pros and cons, of course, there are a lot of positives and negatives to each side when it comes to how the protocol integrates with oracles. But I know a few weeks back, whenever NFT floor prices really got hit pretty hard and there were some liquidations, that was one feedback point we got from a lot of our users, that they weren't up late at night sweating those ones out, so worrying about getting liquidated during their loans. So that was just something that I figured I'd jump in and mention right there.
Yeah, no, I'm glad you did. definikola, you said that it kind of shifts from the oracle, elsewhere. Maybe we can speak about that because there's always a trade-off, right? So what exactly is this trade-off here in terms of the lending protocols?
Yeah, of course. Well, in terms of lending protocols, you have also the liquidity provider side, or let's say the suppliers as users who are now taking the risk of the oracle risk by lending certain assets at a certain price. So yeah, the protocols themselves, the oracle free protocols, took the approach of not having oracles by finding a mechanism to trigger liquidations without them. And that's the way they kind of shifted that risk to the end users. It can be correlated to, and like the liquidity providers on the Uniswap free, because the liquidity provider side became a much more complex when it comes to management of that liquidity, because now suppliers, for example, need to check the oracle, the external price feeds themselves, and see whether they are not loaning assets at the wrong price, because they don't want to end up with a bad debt, like the previously some protocols did in case of oracle risk attack or something like that. But yeah.
And Sophie, tell me what you guys are noticing on your side, because you had actually introduced me to something new. I think we're all at least somewhat familiar with MEV, right? But recently now I'm seeing a little bit more about OEV.
Oh yes. So the OEV is called the Oracle extractable value, and that's basically all about the liquidation data that we have been identified. But currently, the liquidation is doing by backrunning the Oracle's update. So that's why the value is extracted from the Oracle. And I think it has been taking so recently I have been investigating on how much OEV is for the total of MEV, like compare with other MEV activities like as arbitrage or front running as a sandwich attacks. But even though liquidations that was extracted from the oracles is not compared with other MEV, but it's still can extract around $1 million for last month and even $2 million from the month of May. And because the currently still the market is quite stable, it didn't compare with last year of happens for the Luna crash and also the FTX crash, creating a lot of market opportunities for the liquidators. But it's still in the stable of the market. It's in the stable situation of the market. The liquidators still could extract value around 1 million from the Oracle's updates. So that's the OEV data that we have been observed. But since Jen has mentioned earlier about the oracles, the value has been extracted from the oracle attacks. I'm just very surprised to see the number is so high, because we do observe a single oracle attacks happened, but we didn't conclude all the numbers. But now the numbers showing surprisingly high. So the oracle attacks could happen because of there is some latency of the oracle updates on the price. So we do observe some attacks what happened in a protocol called abracadabra. And that's what we have read a paper before. So it's the attacker utilized there's a delay in the oracle updates on the rate, and so the attacker just use the first rate to borrow and wait for the rate to be updated and then liquidate the position. So it's just like utilize the market because the collateral assets has experienced a sharp decline in that day, and utilize this like market situation to exploit the contract and gain a lot of profit. That's just like only one Oracle tax that we observe. We do observe like huge amount of the Oracle tax using like a manipulate of the low liquidity assets to initiate attacks. So that's the value that we have been observed from or like we have been observed that extract from Oracle, including the Oracle OEV and also the long tail OEV, like the attacks that I mentioned.
Okay, so you said a couple of things that really caught my attention, and definikola and Steve, you guys can jump in here whenever you want. I know sometimes I'll call on a speaker, but feel free to jump in. If any of our listeners want to jump up here and ask any questions, please do at any point. You said they kind of back run them. That almost reminds me of a sort of sandwich attack.
So sandwich attack is like a front run the Oracle, front run victim. But the background of it is meaning that it's just like include the Oracle's update in the bundle to do the liquidation. So the liquidator needs to know the liquidation opportunities happened like on the first position to know there's a liquidation position going to be liquidated. So that's what they are doing now. They just like bundle the Oracle's update transaction into their bundles and send to the builders, so their liquidation transaction could be executed. That's what have been observed recently, called the OEV, and also cause a lot of intentions from the market, that how they are doing liquidations right now.
Okay, so that combination of the front run with the back run, right?
It's just like simple background of the Oracle updates. It's no front run. There's no front run.
Okay. Okay, and then I guess the other question that I had for you is, you said low liquidity. Are you seeing it more often with low liquidity lending protocols or protocols in general? Or is this more across the board? Like, what can users look out for? The type of Oracle being used and then the sort of trade-off being made?
Yeah, there's some attacks happened because of the manipulation on the low liquidity assets. So the way I mentioned about low liquidity assets is there's a huge amount of assets of that token has been deposited into lending protocol, and the assets that is flowing in the market, that is like what we call like the true liquidity in the market, is less compared with the assets that's being deposited in the lending protocol, and that's a chance that the attacker could like use the liquidity that has been flowing in the market to do the manipulation on the price for the lending protocols, like the rates. And that's some famous attacks that we've been observed, like the mango squeeze on Solana last year happened. It's like a very similar mechanism of how to manipulate low liquidity assets. And also one famous attacks happened last year in November is the CRV liquidation events. So actually, I think the victim, the attacker becomes the victim in that events, because they like initially wants to manipulate low liquidity assets, but got squeezed because there are some liquidators coming to play to drag the CRV token price up. So it's just like a mass competition between the attackers and the liquidators at that events. But that's some like famous events happened last year, based on what they tried to do to manipulate on the low liquidity assets. I think that is quite dangerous if there are less assets flowing in the market compared with the assets that has been deposited into the protocol.
Yeah, and last year, I don't know if I mentioned this, but like I said, I pinned it to the top. It was 3.8 billion that was stolen. That's, I think, not just this is dangerous, but I think it's dangerous to the industry in general, right? Now, Steve, when Pawn was first designed, here's Dan saying that we need to fundamentally rethink how DeFi protocols are designed and secured. This was a concern when you guys were designing Pawn. I mean, this was what I'm saying?
So I think my service cut out for the last bit of that question, but I think I got the gist of it. Was just kind of was the Oracle free state something we had in mind when we were initially building Pawn? Is that right?
Right.
Yeah. So I can't say I was there from day one whenever Pawn started being built, but that is something that's been a core concept of ours as we've been developing this protocol since I guess early 2020, whenever it first started as a hackathon project from our founder Joseph. It's really something, especially with kind of, as Sophie mentioned, these low liquidity assets, that we really look to support those kind of communities, especially, so we don't want them to be able to fall victim to attacks like this. And that's really where it comes into play a lot. So that is something that has been a core belief of ours as we've been building out the early functionality of the protocol here.
And definikola, do you expect to see more? You're saying it's becoming a thing in DeFi. Do we kind of see this shift happening now, or we'll see more and more Oracle-less protocols?
Well, I see it would depend on the users, because it's essentially a balance between, the trade-off between, do you want to make the supplier side more complex, and do you want to how do you incentivize those users to become the suppliers? Because, for example, it's way more easy to be an LP on Uniswap V2 than the Uniswap V3. But yeah, I think it will be the same for the lending protocols regarding the Oracle free and the lending protocols that are using Oracles. So yeah, I think that Oracle free approach would probably be very helpful when you have the collateral whose price is very difficult to calculate, like Uniswap V3 LP positions or something like that. So I would expect a lot more protocols that have that in mind to pop up and to say, okay, we do not have Oracle risk, and we will find a way to incentivize the liquidity providers. So yeah, I think that's my best guess, but yeah.
And maybe because Mark isn't here, I can speak to Carbon a little bit, because Carbon does not rely on an Oracle. It is an Oracle-less protocol as well. It's a trading protocol, but there is no price on Carbon. So he has often spoken to it and related it to something more of an eBay. What determines the price is the actual users of the protocol. So you have your makers who say, I'm willing to sell at this price. And you have your takers that say, I'm willing, buy or sell at this price. And you have your takers who come in and say, I'm willing to take you at this price. So it's really the market, it's the users that are determining the price. So there is no reliance on an Oracle. And I think that's one of the first questions that we got, when Carbon was first announced, was, will you be using Chainlink? What Oracle are you using? And it was kind of a newer concept that this was not relying on Oracles at all. But I think Oracle-less protocols have been around for a minute, depending on the sort of protocol um, that you've created, right? That have been developed. Why now are we seeing more and more? Is it just the shift in builders saying, you know what, I don't want to expose, like you said, Steve, it was, we want to protect these different projects that have low liquidity, the users to an extent. Is it hopefully, like this space kind of making this shift here? I don't think it's the users, unless I'm mistaken. What's your guys' take on that?
Yeah, I'd jump in. I'd say maybe a little bit of both, honestly. As the space continues to grow here, I think we're seeing the pie get bigger, even necessarily more so than just like a shifting of one way or the other. I think just naturally as it grows, like there's going to be a lot more experimentation to people playing around with the idea of like, hey, look, we don't want to rely on an oracle that could potentially make us vulnerable to a lot more exploits and things of that nature. So we're just going to keep pushing forward with this maybe less traditional path in a sense than having to rely on an oracle, but That's just maybe my perspective. I'd be curious to hear what the rest of you guys think.
Yeah, I mean, I would agree, and I think that Oracle free lending protocols are not explored as much when compared to the lending protocols and money markets we are used today. For example, like Maker or Aave, Compound, and I think it would surely be interesting to see their usage and the behavior, because as Jen said, it's basically creating your own price and being your own oracle uh, by matching the users from the both sides, so like makers and takers, and just in general to. I think it would be interesting to experiment with the approach of not having oracles.
Oh, I think I do observe there's a lot of the efforts to trying to improve the current Oracle design, like trying to provide some risk management, like keep monitoring the on-chain liquidity so you can avoid some low liquidity assets manipulation. But I'm very curious. I got a question to ask the definikola and Steve. How liquidations actually happens for the Oracle free protocols, how to like protect the protocols, also like the makers assets.
Steve, you want to go? Yeah.
Oh yeah, that's so I can of course only speak to our protocol in that sense, but the way that we have it designed by nature is that there are absolutely no liquidations. And Sophie, I'm sure this was kind of leading up to your question of how do you, I guess, protect on the lending side. And that's sort of baked into the fact that we see usually around a 50% loan to value ratio throughout the duration of our loans. So that's kind of a little bit uh, baked in there to protect the lender in terms of like a price swing throughout the lifetime of the loan. At least I don't. No, I don't know if Nicola, you have anything else you'd like to mention there in terms of liquidations.
Yeah. I mean, some protocols went with the approach to have a like expiry date and say, okay, after this date, the loan is closed. And that's the way to trigger liquidations. And for example, Blend, the Blur's lending protocol, which is peer-to-peer, their approach is that the lenders can at any time trigger liquidations, and then some grace period is given to the borrowers, whether to either to find a new lenders or to pay back their debt. And the third and probably the most complex approach is the approach the Ajna protocol is taking. It's some complex math under the hood, but yeah, I think they are pricing. They have like the dynamic liquidation price, which depends on the user behavior, both from the suppliers and from the borrowers. So yeah, it's a bit more complex, but yeah, they also have a way of comparing two values and saying, well, now those positions can be liquidated and those cannot. Those still cannot.
Yeah, so I'm glad you mentioned the fixed duration too, because there are still the possibility of defaults, but uh, just not liquidations. I guess more of a vocab specific terminology there, but just wanted to add that in before we hand it back to Jen.
Yeah, I'm curious. You said it was like a 50% loan to value, right? That seems, and it's kind of nice because it's a little bit more risk mitigated. We see up to like 90% loan to value that's lent out. So do you see this approach being successful in terms of pawn?
Yeah, we've still seen a lot of traction with it. At the moment, our typical loan duration's usually 30 to 90 days. So that 50% price swing, I'd say, is not very commonly seen where it would benefit the borrower to default on purpose. So yeah, it seems to be pretty successful from our point of view, but I can't obviously speak to too closely to the data of other protocols.
Sophie, you were asking about liquidations, and I know that this is like a main type of MEV. So I'm curious what your thought is on that. I know you were asking definikola and you're asking Steve. I'm curious your thought on it.
Yes, I'm just very curious about any design that could avoid this kind of over liquided transactions happened. I think liquidations is a way to protect the protocols, right? It's got, if you got like extreme market situations, and then the borrower's position got liquidated, and then that's just like protection to the protocols. So that's why I ask a question: if there is like no liquidations, how to protect the protocol's assets and also protect the user and the market and the maker's assets. So my understanding is the liquidations is, you can not say like it's good or bad. It's just like the market nature happens. But the Oracle attacks is definitely needs to be avoided. It needs to be, the Oracle's design needs to be improved. The whole ecosystem needs some risk management, like also like the liquidity monitoring, to monitor the on-chain liquidities to avoid some low liquidity manipulations. So this kind of things need to be improved to avoid the Oracle attacks. And that leads to another question I want to ask for definikola or Steve, is like for the design of the Oracle-less protocols, how to avoid the latency on the price. So if like there's latency of the price, and still it could cause some troubles, like they could manipulate, they could attack the lending's position, the liquidators positions, right?
Go ahead, Steve.
Oh yeah, I was just gonna jump. I'm glad you mentioned the pros and cons side of that again, Sophie, just because I think as we see Oracle and non-Oracle based protocols grow, like we'll see a lot of really great solutions on both sides. I think as we work towards a happy medium there eventually. But that was just a comment that I originally put my hand up for. And just to make sure I understand the question you were asking myself and Nicola properly, was it was regarding price latency and how to protect the lender against
Yeah.
the risk of that?
Yes, that's my question. Yeah.
Yeah, and that's actually something that's pretty tricky, at least as far as my technical knowledge goes, which is semi deep, but definitely could go much, much deeper. We kind of see the best defense right now, in our case at least, being that loan to value ratio to kind of give a little bit of a buffer there in a sense. But I'll pass it over to Nicola too. I'm not sure if you have any other input there that might be able to offer some more insight.
Yeah, thanks. I think that the risk is actually on the lenders themselves, and I think that we now have to create some third-party solutions. I mean, even DeFi Saver could jump in and help the lenders there by automating some rebalancing. I mean, rebalancing the liquidity from and liquidity positions. I mean, the suppliers and their positions according to the external price feeds. So I would expect some projects coming up and saying, okay, let's make the process of liquidity provisioning easier now in Oracle free protocols, because lenders now do have a risk of ending up with bad debt, meaning that their collateral they are lending is now valued less than the amount of debt that the borrower took. So I think it would be a too complex job for the lenders themselves, and I think that the projects like, for example, DeFi Saver, I mean, we are definitely exploring that field, that the projects would come and say, okay, we want to make a job easier for you guys, for the suppliers, by automating the process of liquidity provisioning. For example, just by tracking the external price feeds and rebalancing your position according to it. But the risk is definitely now, in Oracle free protocols, the risk is definitely now on the lenders themselves as users.
And just to jump in, actually, one other solution that just came to my mind in order to protect lenders, and this is something that we've actually discussed potentially building here in the future with partner is the idea of adding some kind of insurance for the lender during the duration of the loan in case of a collapse of the value of the underlying collateral on the borrower's side. So I think that's something that is also really interesting that could be baked into it, is like maybe a 1% or 2% kind of fee on the loan itself, but it would also insure against that underlying collateral losing value during the duration of the loan.
Is that something that's currently available? Not, I mean, I know you said that Pond was looking into it, but is that something that's currently available to other lending protocols? Are there insurance protocols that are offering?
There are on-chain insurance protocols. The one that we had been interested in was called Insuro. I'm not sure if they actually have the integrated solution when it comes to lending at all, though. So that's something that maybe someone else could fill in if I'm missing there, but not that, to my knowledge, exists at the moment.
Yeah, just curious because as DeFi Nicola, like I said, he and I shared it up here, it's becoming a thing in DeFi. So hopefully we'll start to see more of those, third-party solutions, DeFi Saver being one of them as well. And hopefully, we'll start to see more of a secure Oracle, having a presence in these protocols. I think it was Euler Finance that suffered that, what was it, over 200 million this year. And that was an Oracle exploit. And I know that they were looking into, asking, at least tweeting about Oracle free lending. So it is definitely becoming more of a thing. And Oracle free, Oracle-less protocols in general. I mentioned Carbon being one of them, and they're a trading protocol, so um, hopefully we start to see more of those and less stress on both the lenders and the users as well. If you guys have anything you'd like to add, I want to give you the opportunity, and I want to open again, invite any of our audience up here to ask any questions that they might have. Okay, so with that then, I want being up here. Go ahead, Steve, you unmuted.
Yeah, actually, I was just kind of curious. So I know the Oracle free impact has obviously been the focus of our spaces today, but I don't know, Jen, I was curious maybe if you could maybe give a little more insight into how it kind of impacts the interactions at Carbon, because I know at Pond, obviously, we're just speaking on loans and that's a little bit longer duration. I was just curious what kind of the impact of Oracle is, the nature of the protocol with more trading being kind of like a real time interaction. If you could kind of give some more insight on kind of pros and cons of that type of style.
Yeah. So, like I said, Mark has really spoken to Carbon being more of an eBay, right? So it is makers going and creating these trading strategies, and they're really offering their assets. So I have ETH, for example, I'm willing to sell it at this price. Or within this range. Carbon also offers range creation. So you can say, I'm willing to sell ETH at, I have no idea what it is, let's say $2,000. And I'm going to rebuy it at this price, or I'm going to sell it at between starting at 2,000 up to 2,100 or 2,200. So what the protocol does is it breaks down, it creates these limit orders, from 2,100 to 2,200 or 2,000 to 2,100, whatever my example was, and allows takers to come into the system, whether it's arbitrageurs, it's through an aggregator, it's through the app itself, and they can go ahead and they can take these orders. So it's really a direct interaction. It is peer to peer. It really doesn't require an Oracle at any point, just because although trading is in real time, it's more reliant on what those takers are willing to go in and say, yes, I'm willing to take it at this price. It doesn't do anything in terms of what the cost of that asset is at that very point in time. It is very much so the makers and the takers in the system. So there really is no, I mean, I want to say there's no con to it, right? And I will say that I don't know of a con to it. Maybe that's a little bit better a way of wording it. can't speak to one, and if I had one to share, I would openly. I think the pro to it is eliminating that risk that we've been speaking about, right? So there is no risk for the makers or the takers in terms of not having an oracle or having an oracle and exposing them to this. So for carbon, it is very much so. I'm only willing to buy or sell at this price or within this range, and for the taker to come into the system and say, fine, I like it and I'll take it, or I don't and I'll pass. So that's really how it works on carbon in terms of the oracle less, trading system.
Oh,
Was that
no, yeah, that was perfect. Thank you.
Yeah, definitely. And like I said, hopefully Mark will be able to join us and we can do this again. But um, I want to thank you guys. If anybody is interested, by the way, in learning a little bit more about carbon, definitely follow our Twitter and join our Telegram group. We have Carbon DeFi XYZ is the Telegram. We also have a coffee break. It's at 12 p.m. Eastern Standard Time. I believe that's 4 p.m. UTC. Go ahead and join us in there. We run simulations and things, and we can speak a little bit more to the Oracle-less factor, but definitely recommend joining us there. If any of our listeners want to know a little bit more about AgenFi, Sophie, maybe we can just give a run through and let them hear, how to look into these. We spoke to liquidations. We spoke into OEV, which is fairly new. Where would those best resources be?
Okay, so for the MEV, like if you want to know about the MEV, how the transactions actually happened, what is MEV, you can refer to, there's a booklet we just write about all the interesting transactions that we have been including and how to analyze this transaction using our transaction analysis tool AgenTX. And that will give you understanding of what is MEV, and also the OEV that I have mentioned about what is a token, how the token flows between the like within a liquidation transaction, how much the liquidator has been get from how much collateral assets the liquidator has get, and how much the liquidator has to pay to help the borrower to repay the debt. That's all the information you can find in the booklet that is teaching you how to analyze MEV transactions.
Wonderful. Thank you so much. And definikola, how would our audience learn a little bit more about DeFi Saver? You said it's one of the ways that, we can kind of integrate a third party and protect against, the lenders a little bit more. Tell us a little bit more about it and how they would learn more on their own.
Yeah, of course. Well, DeFi Saver has been actually quite a while in the lending space. We aggregate basically all of the blue chip lending protocols like Maker, Aave, Compound, Liquidity, Reflexer, etc. So yeah, we are now definitely exploring the ways to help lenders in those Oracle free lending protocols if they become a thing. Yeah, we also do have automation features for the borrower side, so not to forget them too. And yeah, I'm also occasionally writing different threads on Twitter about DeFi in general and discussing basically the latest developments. So yeah.
Wonderful. Thank you so much. And like I said, one of those threads is pinned to the top. So you can easily access his Twitter there. And Steve, what is the best resource for our audience to learn a little bit more about Pawn?
Yeah, so if you just head over to our Twitter, I think it's here in the chat at PWNDAO, Pondao. There should be all the links in the bio you need there. We've got plenty of docs. There's a blog channel and everything for people to find out and learn more. Or feel free to just reach out to myself. DMs are open. I'm always happy to talk all things Pawn.
Perfect. Thank you so much. And like I said, if you want to learn more about automated trading, and the sort of unique features that Carbon offers, definitely go ahead and check out the Carbon Twitter and the Telegram and join us in the coffee break and the Bancor Discord in 5 hours. Thank you guys so much for joining us. Sophie, I know you'll be back. We haven't yet announced it officially, but you'll be back for us to dive a little bit deeper into OEV next week. So I'm looking forward to that. It's great to have you back and wonderful to meet you guys and connect, DeFi Nicola and Steve. Thank you so much for joining us. And thank you to the audience as well.